I am very honored to introduce, I'm going to do all three very quickly, but we have three back-to-back Angel Talks. They're 15 minutes each, and they are going to be lights out. So we're going to kick it off first with Mike Hansen, who opened the Chicago office for LinkedIn and is now running Permanent Ventures, which thank you very much, Mike. They're one of our venture partners, and they're supporting what we're doing here today and throughout the year. And then we've got Amanda Lannert after, and Amanda is the head jelly. Don't you have one of those funny, I'll like your dog? She's the funniest stuff on it. Go to her LinkedIn. Meet her before you invite to connect with her, but her LinkedIn is hilarious. And she is definitely one of the best CEOs I've ever met. I probably still should say the best CEO I've ever met, which is hard because I'm investing in a lot of CEOs now too. And I've not invested in Jellyvision. But she's incredible. Everything she says, I take notes on. And then we also are finishing with Jeff Eschbach, who is exited founder. He started a legal tech company called PageVault and had a great exit for that, and has been doing all sorts of other stuff, like teaching at Kellogg, which is really how we got to know each other, as well as Chicago Early. And I have to give another shout out. It's Brian and Jeff that are doing Chicago Early. I've been saying since COVID, the most important thing that is happening in Chicago tech is literally what those two guys are doing. They're growing new angels, and every opportunity I have, I send them more people that are angel curious, as well as with Josephine Collective, because that's basically a clone. So if you guys know angel curious people too, please send them to all these sources that you guys are hearing about. Okay, so with that.
Great, thank you. Hey everybody. Nice to see everybody. I'm going to take you in for a moment and figure out with whom I'm speaking here. All right, I got you. Many new faces for me. How many people in here have ever done an angel investment? Okay, and how many people have not? Okay, so we are like experimentally curious, like you've done it, you didn't suck that bad, and you're like, I'll do it again. So I would say, I was asked, I think, as there are a number of other folks here, to talk a little bit about our own experience in doing this. I'll share in a minute. Headline, so there's no suspense, is that it's hard, I mostly lose money, and it's fun, and I'm semi-addicted to it. But the other stuff before that, and again, I'm mostly Amanda's warm-up show, just so keep that in mind this time. That's why I was asked to come here, is like, and now, like that part's coming in a second. So I was a long-time software operator for 25 years. I worked in 3 companies. 2 really worked, 1 was good. And through that, I learned a lot of things about operating at scale. And I got to join one company that was really tiny, and it got really big, and that was a real life changer for me, and that afforded me different kinds of opportunities to figure out the mechanics of what it takes to go from a little company to a big company. And so when that second company I worked in, LinkedIn, when it worked, and I ended up with a bunch of capital dumped on me that I didn't grow up with, and I was asking myself, so now what? So what do I do with this? And my wife and I had a whole bunch of those conversations about how we show up in the world and what we care about. One of the big winners for us in terms of where we wanted to put that capital was back into the entrepreneurial ecosystem from which it came. And so that was in 2011. So from 2012 to 2020, I was probably as promiscuous an investor as you would find. And if you were an entrepreneur in that time, I'd probably back you. And I was like, yes. And when I look back on it, now from a place of more than 10 years, and which is enough time to begin to see some of the things bubble up in your angel portfolio. What I learned are following things, so I want to share a few of those things. So the first is that mostly you're wrong. Right, whatever you are, you're making an early angel investment and you've got some thesis about the person or the market or the thing or the competitive landscape. Mostly you're wrong. And I don't mean mostly like 51% of the time, I mean mostly like almost every bit of the time. Now, sometimes you're wrong and it still works out well, because you could be wrong about the market, you could be wrong about the vision, but if you're right about the founder, and she or he can pivot into something different, that's some of the most amazing outcomes. I worked for a guy for many years named Jeff Weiner. He's a super close friend. We've done a bunch of stuff together. I used to say one of his best angel investments, it's no longer the best because Figma just happened, but one of the very best angel investments he had made for many years was in a company called Slack, which you've heard of, and it didn't used to be Slack. But Stuart was a buddy of his, and so Jeff put in $25,000, which is like a reasonable sized angel investment. And his first company, what he invested in was just like a gaming related company that had some messaging in it. And when he realized that that was a crappy idea, and he pivoted to let's just do the messaging part fully, turned into a big outcome. So wrong about the market, wrong about the strategy, right about the guy. That happens a lot. So that was the first big lesson, is that most of you are wrong. Second one is that it takes a really long time in general. So if whatever your budget is, if you've got $1, $100, whatever your budget is, and you're picturing some period of recycling those winning dollars back into the portfolio, I would just like stretch out that period of time until you're going to see those dollars again. Because even in a really good case scenario, and you will definitely have some, or probably have some really good case scenarios, this takes a really long time. So think about how you segment out that investment curve. By the way, something I did very poorly on myself. I'm not speaking to this from having this all went well for me. I'm speaking to this from now 10, 15 years later being like, here's what I wish I would have done. So it takes a little bit longer than you expect. I think next thing is separate for yourself and why you're doing this. There's a lot of, I think, very reasonable and rational motivations in angel investing that are the reasons that people angel invest. Sometimes it's, every once in a while, it's because they believe it is a better return on dollar than anything else they could be doing. It's possible. Sometimes it is because they are intellectually curious about an area of the market landscape, and as I used to think, want to buy a ticket to see the show. Sometimes you're being supportive of something you care about, an idea, a person, friend, a trend, a social thing. Lots of very valid reasons. But what I've found is that in my own muddled earlier stage investing, sometimes I conflated those things. And so maybe I was investing primarily with a mission orientation, but then when other parts of the business didn't materialize, I was not the right advisor or helper to them. Sometimes I was investing with an interest in the market, but I didn't make enough time to go deeply and actually get the learning that I wanted. So just be clear with yourself about why it is that you're interested in that specific company, what your goals are from investing in that. Is it financial, is it educational, is it to help, or is it to furnish the movement you care about? And then set up the time that often goes with the money so that you can actually make sure that you get the returns that you're looking for. And kind of that idea of time and money, I've ended up borrowing a phrase that I learned from a guy named Jeff Nelson, who's the CEO of a nonprofit, wonderful nonprofit in town called One Goal. He's no longer the CEO there, but he used to talk about things in terms of time, talent, and treasure. And so when you're angel investing, you often are really investing all three: your time, your talent, and your treasure. Treasure is what you don't usually talk about. You're putting in $1,000 or $10,000, whatever your number is. But really, if you're making an angel investment, you're probably pretty close to the founder, or you will become close to that founder. He or she probably really wants more than just your money. It's your help, it's your network, it's your time and talent. So I would think about kind of that full idea. And then the last thing I would think about just as, again, keep in mind, see earlier point, just warm up act for Amanda. That's coming soon, ladies and gentlemen. She's standing right here and she's getting excited. I know you're getting excited. We're almost there. Just one more thing is really that you're investing in a community, right? In this local community, angel investing is a hyper-local activity in almost all cases. It's very common, if you look at the opposite end of the spectrum of company maturity investing, if you were growth investors, if you were investing in the big pyramid of companies that start with many thousands on top and get to very few, thousands on the bottom, get to very few when you're on top. If we were growth investors, later stage companies, those could be anywhere in the world and we'd know which ones they are, and we would say it's not at all regional, but angel investing is the opposite. It's people down the street who are in your building or crashing on your couch or have an idea that they talk to you about at a cocktail party. So remember that when you're angel investing, you're investing in your local community. You're investing in ideally the businesses that drive the flywheels of tomorrow's success and tomorrow's investment. And so I would really encourage you to think about it as a civic responsibility or civic opportunities. I think you've done such a great job of, this community is a wonderful manifestation of that. But there's lots and lots of ways to go about it, in my opinion. There's no right way that I know about. The smartest people in the world are mostly wrong, and so don't feel bad about that for yourself. Just have some clarity of thought what you're trying to achieve, have a thoughtful duration that you're willing to run after it, and then get into it. It's amazing. And now, with no further ado, not yet. Oh, I got something for you, girl. Not yet. So, no further ado. So, when you're picturing the founders that you're going to be angel investing in, they might one day grow up to be a CEO who's leading a company with as much thoughtfulness, energy, vigor, authenticity, joy as Amanda Leonard, and who has done so through like all kinds of market cycles, all kinds of people around her, and has found the time, even though she's a busy-ass CEO boss, to every single thing in the city like this, to show up and just like give and do it and share yourself. It's amazing. So ladies and gentlemen, with now truly no further ado, I give you the real, the one, the only Amanda Leonard.
I remember joining the board of P33, and it was one of those rooms that you walk into and you're like, I don't know how I ended up in this room, because everybody is so impressive and they're going around the room introducing themselves, and people are like, I'm CEO of this Fortune 50 company, and I'm this, and Mike Gamson goes, well, I'm a dad. I like to surf. And it was just like the most human, humble thing. Mike also is the patron saint of angel investing in Chicago Tech. He won the Chicagoness Award because he backed and led the way for more companies than you can name, including some of our biggest exits that are soon to be Logic Gate, Spot Hero. They would all thank him on their very, very short list of people. And then I'm going to be followed by Jeff, who literally teaches angel investing. So I thought, between these two, what on earth do I have to offer as sort of like the amateur hour? And I thought the least I could do is be really, really honest. So I'm going to tell you a few stories, my lessons learned, how I got into angel investing, etc. And then I'll pass it over to Jeff, who will probably run a masterclass on how to get great returns. I started angel investing with a $5,000 check that was for a VP of marketing who had been an early customer of ours, had hired Jellyvision, and then she went to start her own company. And the reason why she went to start her own company is she had a son who was born with a severe birth defect. There's a wrapper around your brain, and his was perforated. He had multiple holes in the lining of his brain that caused all kinds of real challenges for him around talking, sitting up, walking, whatever. But one of them was he couldn't chew and swallow. And so when you can't chew and swallow, you get put on a feeding tube. And this woman, Julie, realized, I want my kid to be as normal as possible. I want him to be on the go. We're an on-the-go family. We have other kids. We're going to do all the things. And so instead of always feeding him a feeding tube, she would blend the family's food and put it into a pouch and then feed him. And she noticed that when he had real food, his color was better, there was less phlegm, he was alert, there was a brightness in his eyes. But when the family was on the go and she had to switch to the pouch fed, the pouch that you buy for people on feeding tubes, his color was bad, he was phlegmy, energy was different. And she's like, something's up. And she read the package and she realized patients who are feeding tube fed have mostly high fructose corn syrup. That is the key nutrient of what we feed people who are on feeding tubes. And she goes, that ain't right for a developing brain. That ain't right for a little baby. And so she started a company to put real organic meals into pouches so that feeding tube fed people on the go could have real food. And I thought that was cool, but I didn't understand the economies of food production, waste, FDA, all those kinds of things. So I was like, nah, it's not for me. And basically I was told, you need to represent, you must support, show up for this founder the way she showed up for you by being a customer. And so my first check was $5,000 that was pride from my hands, where I'm like, I'm still working for a living. And that's how I began angel investing. And as I started to get more and more checks, largely because of the founder of Jellyvision knows a lot of people, and he'd be like, go talk to her. I ended up joining Hyde Park Angels, and if anyone afterwards wants to talk about why you might join a group and what it can do for deal flow and, deal structure and protections and wrangling tax forms at the end of the year, there are a lot of reasons, but for me it was largely, I thought at the time it was a platform. And so I joined, and they ask you, why are you joining? And I said, because, everyone's like, men in tech, they put their hands on you. And I'm like, yeah, they put their hands on me, on my back to push me forward. I am the recipient of an extraordinary amount of mentoring from mostly white men in Chicago Tech, who I truly believe fought for me to have a seat at the table with the expectation that I would pull up other chairs, right? So I was like, I have to give back. There are mentors in this room, by the way. That I have to give back. I have to be present and show that you can be a CEO and you can be an angel investor. And Jeff Kleben, who was one of the sort of patron saints of Hyde Park Angels, said that is a terrible reason to be an angel investor. There are way less expensive ways to be a feminist. And he made me read the book on angel investing by David Rose to learn about portfolio theory and how to get started. And I do it because it is a high-risk, largely illiquid, mostly long-term asset class that with a strategy and discipline, you can create outsized returns. Okay, so that's me getting into angel investing. The next, it wasn't a platform. I wasn't doing it to support or show up or to be a feminist. You do it because it is one of your asset classes and it tends to be on the higher risk and with the potential for outsized return. So I'm in HBA and I'm cherry picking deals, like I know better than other people, and I would only invest in companies that I thought I could run, meaning I know what to do. I have a thesis, this is familiar to me. And now, 10 years later, most of my returns are businesses I don't even understand. Like, I'm an investor in ShipBob. Something about logistics, something having to do with TikTok, I think. I don't know, but they're gonna make me a really nice return because I was in the first round of institutional capital for ShipBob. So it is about not getting started. You write the one check and you hope for the best. You get started because you're gonna write 25. And that's something people don't understand. If you can't do 25, don't do one. Wait until you can do 25 and then place them slowly over time because it really, nobody gets it right more than 10% of the time, if you're lucky. So after lots of investing, I'm in 50, 60 companies, a couple $1 million deployed at this point, largely because we had a secondary round at Jellyvision. It created a lot of liquidity. I'm unemployable elsewhere, so I said I need to get a way to diversify my portfolio and started aggressively investing. So my losses, this is my wins and losses in 15 minutes or less. I'm gonna start with my losses, which again, don't bother me that much because they're all lessons and I'm wrong way more often than I'm right. The first is be very thoughtful about investing in friends. I have invested in friends, and the better the friend they are, the more quickly they go to zero. And one of the lessons that has guided me is if you are able to make a choice, you want to go after a big market with rich players rather than a small market with poor players. And I have allowed friends who I just believe in so much. They say it's the founder fit, it's the founder fit. Like, I believe in these people. I would run through a wall for these people. I know them. But still, that tilt, when you look back in hindsight, selling to rich people is easier than selling to poor ones. Any vertical. The second is real talk. And this is just me. If it sounds too good to be true, it is. The largest check I wrote was $300,000. And it was to Outcome Health. And it was the month they got put on blast for fraud. And they knew it was coming. They knew the Wall Street Journal that was going to break the news was coming. And I learned in that moment, thinking about the due diligence calls I had heard, they were asked, what could slow you down? And they said, absolutely nothing. And I remember thinking, my normal check size is a lot smaller, but this is it. This is the real one. This is too good to be true. And I decided in that moment, and lessons in hindsight after it kind of imploded, one, there will be people who make a lot of money investing in sociopaths. I'm not going to be one of them. And two, sociopaths make a lot of money for people, but I'm not going to be one of them. And two, do not lose discipline. If I had written a $25,000 check or even a $100,000 check, how much less would that sting? But I bought into the too good to be true. It is a game of discipline. You never know. You don't believe the hype. But if someone says it's too good to be true, I believe them now, after years and years of investing. And sort of a third lesson of like where I look at the founders I love and their innovators, there's a question you can ask yourself that will help you understand, is it going to be an outsized outcome, or is it just going to kind of be a thing that sustains but never really goes there, doesn't go there? Is this a feature, a product, or a company? Companies have great exits. Features manage to pay the bills but never quite anywhere, and sometimes products can have great exits, but there is actually a difference. Feature, product, or company. And it really is, what's that 1.0 thing? And you can say, well, Slack was a feature, right? Well, it was a product. that then became a company because that product was important enough. And that's what the insight they unlocked there. And I'll throw one more regret I have, because he was supposed to be here today, but is deathly ill because I was texting him. I regret the miss of ReloShare. ReloShare was brought to me by 3 separate of my top 5 mentors. Like the people I most listen to about my life, the people who have had my back, and they're like, we got this guy, we got this guy, we got this guy. And I loved him out of the gates. I really thought Matt was just aces, but the business was something about sex trafficked workers and helping them have places to stay. And I was like, this sounds like an amazing not-for-profit. I'll give you a charitable donation, but it doesn't sound like a startup. And what I had missed was the market. The users were sexually trafficked people, but the market was, in America, you can only stay in a hotel if you present a federal ID, like you have to credit card and your ID. And that is bad for people who can't or don't want to produce identification. And what ReloShare did was invent the only federally approved alternative to identification for people who want to stay in hotels. And yes, it works for victims of domestic violence, but it also works for immigrants. It works for diplomats and government workers, and they are just killing it. And it was one of those things where I had pattern recognition, I had social proof, the founder was amazing, and I didn't listen well enough to understand there was a technology play versus a not-for-profit. And I passed once, I passed twice, I passed 3 times at the first check-in, and ever since then, I have begged Matt to let me in, but their problems are around like cash management. Like they have too much profit and they don't know what to do with it, and that's been the story of ReloShare. So sometimes you regret the ones that got away more than you ever regret moving and getting it wrong. And if you don't follow him, you should follow him. That is going to be a tremendous success story for Chicago. So then let's talk about some wins. Remember that first company I invested in? It turns out not just little kids without brain wrappers do really well on real foods. It turns out human beings do well on real foods, no matter how it comes in. And her little company was acquired by a subsidiary of Danone, and I got 16 times my money back. And my second investment, I had a friend who was at Google, and he's like, he called, he wasn't a good friend yet, he was more of an acquaintance, but he called, he said, I respect your opinion. I want to ask you about an opportunity I have to quit Google and join a startup. And I was saying, I listened to the whole thing. I didn't love the business at the time, but I said, listen, you are running the data liberation movement for Google. You can leave and they'll hire you back. And no one will say with this founding team that you're joining, I don't know why you did it. Like, what's more de-risked than that? You can go back to Google for more money for what you've learned, and it sounds just kind of cool on paper. And by the way, if you ever raise, I'm in. Because I had written a $5,000 check, and so I said statements like that. 4 months later, I didn't hear back. And this person had become the founder CTO of a company called Tock. And he goes, we just had a first round investor fall out. You said you wanted to invest. I'm going to send you some paperwork. You have 4 hours to sign and commit, or it goes to somebody else because it's one allocation. And you can't split it. It's take it or leave it, 100% yes or no, 4 hours. And I get it. And the allocation was for $125,000. And I had done a $5,000 check. But I got all the papers, so I could see everybody who had signed, the people in this room who had signed ahead of me. And I'm looking at all these signatures, and I say to my husband, I'm like, husband, I think we got to do this. He goes, there's a difference between every one of those people and you. To them, this is a $5,000 check. To you, it's $125,000. But he's like, I married crazy, and I know it. If you're going to do it, and let's just do it. And so 3 hours and 57 minutes, I'm like, ballers I'm in, we're going to do this, and I write the check. And it turns out I really hate the business because it's a competitor to OpenTable that lets you cancel or show up with too many people or too few people. And this is no, you have to pay in advance, you can't change your mind, and you're accountable. I'm like, no, food is a whim to me. I like digging over the restaurants. I'm not super in love with this business. And then the pandemic hit, and I'm like, they'll be dead. But the CTO and I, Brian Fitzpatrick, became very good friends. I consider him a very dear friend, mentor, someone, when I'm in town, I look him up and we hang out. But they were building one of the best engineering teams in Chicago. And every one of my engineers wanted to work there, so I'd routinely joke about who have you hired now. I'd go have drinks with them and listen to like the problems they're solving and the sophistication. And he called me on a Friday, Fitz called me on a Friday and said, hey, I need to talk to you. Like, okay, what's up? Who are you hiring now? And he just says, I've been really busy. And I'm like, oh God, it's gonna be a principal engineer. If it were an executive, they'd tell me to my face. If it were a junior engineer, it wouldn't matter. So it's gonna be like a principal architect or something. He's about to tell me he's poached someone that's gonna leave a mark. He's, what's up, Fitz? I've been really, really busy. And I'm like, I'm sure poaching isn't hard, like whatever, let's go. And he says it a third time, I've been really, really, really busy. And I said, oh my God, you sold the company. He goes, we sold the company. I'm like, wow, you should have been dead during the pandemic. That's just incredible, congratulations. He's like, yeah, and you're gonna get your money back. And a couple pennies on top. And I'm like, that's amazing because all my friends go to zero right away. This is like, oh my God, I get my money back on this investment I shouldn't have made. This is like the best thing ever. So we're talking and I'm just so happy for him. Like so out of my mind happy for him. I'm physically shaking. And he says, do you wanna hear your number? I'm like, my number? Sure, what's my number? And he says a number that is so far away from the number I invested. I was like, I don't know what you're talking about. And he said it again, this is your number. And I go, that's what you're giving me back for what I put in? And he's like, yeah. So I'm sitting there screaming, like running around being like, Kevin, talk slow. I couldn't figure out why I was shaking. And I realized it's as someone being in this business as long as I have been, it wasn't the money. It was getting to make that phone call. And I couldn't believe how great it must have been that day where he's like, today's the day I call everyone who backed me and tell them, thank you, here's your reward. And so I couldn't stop shaking. And that day I flew to LA to visit my sister. We check into a hotel, we sit down to have a margarita while our rooms are getting ready, and I'm like, talk money, I tell her the story, and she drags me to the front desk, and she's like, upgrade her to the penthouse. And the whole weekend was like, it was one weekend, but it was great. And so I just want to leave a thought that I wrote out because I thought it was important. Angel investing matters because it fuels the ideas and founders who don't just dare to imagine, they dare to build. And you cannot have invention like birth without blood and screaming. It's awful. It's exciting because you're not just betting on spreadsheets, you're backing vision, grit, and the possibility at the earliest, most electric stage. And it's exciting because every deal is a new story, full of potential, full of risk, and the thrill of helping someone get from nowhere to somewhere, and occasionally, every now and then, you get a banger of a return.
Woo.
Let me pull this back out. Should only be a second. There we go. Security, fingerprint, no. Face in it? No, of course not. Uh-oh. Show one more time. It works. Isn't that grand? That's convenient. Is it still the same as what we did before? Well, if not, I'll have to, there it goes. I can wing it. All right. Let me sit over here. Test, test, note to self. Note
Do you want to have your chair over here so you can see her?
okay, you know what? We'll move it over
Full
there.
service.
Thanks, sir. No confidence month. Got it. Note to self, never speak after Amanda again in the future. That's a tough freaking act to follow. She got better sequencing there. All right, hope you guys can see this. So this is going to be early stage investing trends that we're seeing out there, out in the wild. I want to start off by saying, when I said we, who is we? Brian Crumpo, I think you saw him earlier. This is cleaned up looking Brian. rarely see, this is real Brian. A little kiddo Winnie, good job. But truly, as much as I'm the one up here giving the talk, both of us sat down quite a bit and figured out what are the top 10 trends that we've been seeing out there, and want to deliver that to you all. So a little background here. I know we mentioned Chicago earlier, still want to cover this. So just we have 150 active members, done over 100 deals. We're early stage, 25 to 50K. We don't take a carry. It's been nice for our investors, I think. But we get a ton of great deal flow from all the people, actually nationwide. So it culminates with, we see a lot. So we're out there in the mix, we see a ton. We're industry agnostic. I like having Relo Share in the upper left-hand corner now, after talking about that company. But we've done software, hardware, consumer, how the climate, good, bad. All of it just to say that we're out there seeing a ton of stuff, getting our nose bloodied. We want to share our pain to your gain, that kind of a thing. So with that, top 10 early stage. By early, I mean companies that have less than $1 million ARR, that kind of a thing. Trends that we're seeing, aside from AI. I had people say like, oh, you're going to talk about AI? I'm not going to talk about AI. You all know AI is a trend. We're going to talk about things that are a trend, not AI. So here we go, and I'm going to have about a minute per slide. I've got 10 trends. I think we're doing okay on time. So here we go. Trend number 1 I've got. It has gotten harder to complete a round in the early stages here. Kind of no shock, but I think more time is needed versus 2021 when dollars are a little more plentiful out there. We're seeing, because of that, a lot of times they're doing a first seed round, and instead of it going to Series A, they're doing a second seed. They'll call it a seed prime, seed plus, you name it. These companies are actually having traction. They're doing well, they're growing, but it just leads to them doing another seed round. So thus, we're also seeing a lot of companies that are doing $500,000 rounds instead of $3 million rounds, that kind of a thing. And much more we're seeing them starting small and then to oversubscribe versus leading with, I'm going to do 3 million installing. I really want to press on this. I just can't tell you how many times we've seen companies now say, oh, we're raising 3 million, and Brian and I are like, oh, I mean, you could, but I think you're going to get stuck. And then they do. And it looks miserable to raise $1 million, the round stalls, versus if you just started off saying, going to do 500K, and all of a sudden you get to there and you go, oh my gosh, golly, I had no idea how much interest we had. We're going to oversubscribe, and then you take more and more and more, and you actually build up to the size of round that you want. So we're seeing that work a lot more versus just going big because they stall. Trend number 2 here I've got. Post-money safes at this stage are the new normal. Not seeing price rounds. There was a time when you'd see convertible debt. Not saying we never see that anymore, or even a pre-money safe. But with a cap and usually a discount, we see that quite a bit out there, kind of taking the Y Combinator notes and merging them together to make their own with both a cap and a discount. Usually the founders are setting the terms versus negotiating. At this early stage, no one's going to go out and look for a lead, right? If you're raising 500K, no one's going to lead in the sense of doing legal work with you. So they come and say, here are the terms, here's the cap, here's the discount. It's more of a yes/no decision for the investors. And when you found the safes, a lot of times these founders are losing track of the safes. It can be so easy to get a safe sign for 500K, or I should say 50K here, 100K there. All of a sudden, they've lost track of it, and maybe they're doing a $5 million cap round, and they've raised $2 million on it, and they're not even aware of how much dilution they've got. So where I'm going with that is make sure that you as an investor ask to see the list of safes. Just because it's a cap table, capitalization table, doesn't mean that the safes or the convertible notes are listed there. Make sure you get a handle on that so you know, even in helping them out, so they understand what kind of dilution that they're facing. Trend number 3, I've got out of 10. The push for profitability. One sec. What I mean by that is we are seeing much fewer times where the companies are going to assume the next round will happen. 2021, sure, going to raise money, I'm going to burn that money, profitability or growth of revenue at all costs, because they knew that next funding round is going to come. That's not the case anymore. So quite a bit we're seeing companies now with their plan to get to break even somehow. Or even if they're not going to get there, they know they've got a way to get there if their next funding round is not going to be large. Yeah, slower growth, but they then control their own destiny when they get there. But they could raise a larger round in the future. They just don't have to, right? And we're seeing a lot more of that being the approach. I think companies got burned. Brian mentioned there were companies before that did, they pushed hard, they're doing well, but they assumed they'd get another funding round, and it didn't come through at the size they wanted, and they were toast. Trend number 4 of 10 trends, seed strapping. Now, I don't know if you guys have heard this term before. Bootstrapping is a term where you start from scratch, you get your own money, you don't take any investment dollars. Seed strapping is a little bit different. It's the idea that you need some funding to reach profitability, so you gotta go raise that 500K, something like that to get going. But once you get there, you can kind of keep running things. I mentioned in the last slide, people have a path to profitability sooner. Well, now we're seeing not only they have a path to profitability, but they're kind of thinking that's the plan. I've got there, I'm gonna stick with it, right? So no need to plan to take more money after they get done with the seed round. We're seeing that much more common. Here's a problem. Beware of your safe, right? So you've got these safes out there, and all of a sudden, they've done the safe round, and now they're profitable, and they have no need to go ahead and do that follow-on round that's gonna let your investment dollars convert into equity. I won't name names, but we've got a company out there in the portfolio that has done this, and we did not have a clause in at the time that would eventually convert us to equity. So now, as they're growing, they decide to pay dividends, so everyone who's got equity on the cap table, we've got a safe, we don't have equity, we're not getting the dividends. And that is painful to have unrolled, right? And also with this, we're seeing a bigger issue, and we've seen this blow up in a bad way a few times, that the companies now are not getting to a place where they have a board, and they got governance in place. Normally, once you get to a Series A, you've got a lead investor. Someone's going to be, all right, let's get some, lack of a better term, some adults in the room who've like been there before, can help out. Once they do the seed strapping thing, they're growing without a board. We consistently see that the entrepreneurs don't have the, again, like the guidance and help. Oftentimes, I think the entrepreneurs view a board in a negative way. They're thinking of it as like, oh no, someone's going to tell me what to do, versus recognizing that there would be people there who have aligned interests who want to help you out. And because of this, we've had a few of them go bad where, in hindsight, what went wrong, we realized the poor entrepreneur wasn't asking for help, didn't have a board, and they were in a bad spot. So just something to be aware of with the seed strapping, try to get in front of. Trend 5 I've got here. All right, $10 million cap safe problem. I want to catch my breath and kind of lean into this. I think I've seen this more in Chicago as an issue. So we have got some fantastic organizations, I won't name them, but competitions, accelerators, first investors. They haven't really valued the company. Let's say you're doing a pitch competition and you pick your winners. You have to have a committee thinking through, like, how much are they really worth? So their default is to say, like, I'll tell you what, we're going to give them a $10 million cap safe, and we're going to put 50 grand in, it'll be kind of fun, go them, right? They're just trying to give themselves a little safety net. They're like, we probably think the company's worth 3 or 4 million, but we'll give them a 10 million cap. That way, if something goes crazy good, we at least get this 10 million cap to kind of protect ourselves. But they're not trying to anchor and say that the company's really worth that amount. The problem is, these founders are new and they don't know. They just win a competition, or get an accelerator or whatnot, and they come out saying, "Woo, I just got a $10 million cap safe." They go to the investors. So, like, what's the terms in your deal? 10 million cap we just got from these excellent people who gave us an award. And now they're getting in a bad spot because they don't know that the company's really worth 3 or 4. And it's hard for them, right? No one's told them, given them guidance to say, like, we're giving you a 10 million cap safe, but when you go out there, you really shouldn't go and push for that. There's another term called an MFN, most favored nations, that will allow these guys to get a better deal later on. But when the entrepreneur doesn't know to even ask for literally lower terms, they're now setting themselves up to get the round to stall. So I'm going to encourage people, when you see this or you're part of these organizations, at a minimum, give these entrepreneurs guidance that just because we're giving you a 10 million cap doesn't mean your company's worth 10 million and you're going to go out there and raise the round. Or I also see, like, when they start kind of raising the round from people that are less sophisticated. So maybe they're trying to raise a $500,000 round and they're raising 100 or 200 from friends and family, people who don't know better. And they get to us, we're like, dude, I love your company, but I can't do it at a 10 cap. So, I'm putting this out there as a trend. We keep seeing it over and over, and it frustrates us because we want to back them up, but they're anchored on 10 million. So, those of you that maybe have some influence in those spaces, we can chat later. All right, let me check out time. Well, we're not on time. Trend 6, dead equity. So, more and more we're getting to see companies. Dead equity means they've got people who have a slice of the company that are not involved in any meaningful way and should not have equity, right? So a founder who stayed for a month, oftentimes you see this where 2 founders start a company, 1 founder's there for a week, they get bad guidance from the lawyers and they form docs, there's 50-50 split, and 1 person quits, and they've got 50% of the company. What are we talking about, right? We keep seeing that a lot. More common scenarios, oh gosh, I've got this. I have a school I will also not name, but they have a class project where the students come together and do a little class group, do a startup idea, and they have a signed document that everyone in the group has at least 1% of the company. And you get some clown who shows up to the class, does C- work, done nothing, and then they leave, and now later on they got 1% of the company. And that's it. And the poor student doesn't know. They're like, oh, I gotta sign this thing for my class. So another example of debt equity. This is more common. We see unhelpful advisors. And I'm gonna actually challenge people that are new angels. You may think you're super helpful. Even if you are, the protocol is not to go and say up front, I want a board seat and I think I should have 5% company of the company for helping out. So we get a lot of these helpful advisors that somehow are not helping 6 months later and they're on the cap table. So don't cause this, right? Too often I see these advisor shares early on, even though the advice they're giving isn't that great. I've done advising others, I think, here as well. The normal protocol is you actually help out for a year, and then later on when they're gonna go do a round, or they're gonna have, let's say, an equity pool, or they've got an option pool, that's when they come to you and say, thanks so much for helping out for the last 2 years, here's some equity, versus demanding it up front. It's just, when I hear that, that's a red flag to me. And the way to solve this is encourage vesting. On any of these things, you want a vesting structure. You want to give someone equity, that's great, but they need to prove themselves 6 months, a year, before they get a little slice. Trend 7 of 10 here. Legal issues. All right, Brian, I'll admit Brian, that may have been more sensitive to him because he's aware of this kind of stuff. But we see some real problems out there. And we're talking early stage stuff, and we're seeing the legal issues here, right? Oftentimes it comes because they're trying to save a few bucks, and Uncle Bob is a lawyer, but not a startup lawyer. And when they go down that path, Uncle Bob doesn't know what to keep an eye out for. Without getting into the weeds, 83B, which protects you from tax payments that you have to do too early before you've had an exit. QSBS, that's a mechanism to when you sell your company 5 years later, you don't have to pay a lot of taxes. We see this get screwed up, and it's very hard to undo. Literally talking to a portfolio company, a friend of ours has a company. I think they're valued over 50 million at this point, and this person's going to be out 15 million, 15 million, because they didn't set up QSBS right. They saved a few $100 up front. So yeah, that's a ouch. So anyways, be aware of that. We're seeing it. Illinois Angel Tax Credit is also in this space. Love the Illinois Angel Tax Credit in theory. We used to have this mechanism going pre-COVID where investors can basically save 25% off their investment. The problem is there's requirements that the companies who qualify have to maintain a certain amount of Illinois employee.
You just improved that, by the way.
Oh, did they fix it?
Yeah, no, not fixed, but it's improved. We're working on it. Yeah.
Well, see, I was saying,
Christine,
I know
you
we're
can talk to
working on it.
No, actually, something was signed.
Oh, I didn't know it's not.
Yeah,
All right. So this is also why it's so important now. It's true, I get to know it. Community matters,
Yeah.
right? And having the community people backing up. All right, I'm glad to hear that. So my news story on that is like, yay, this is awesome. We're going to keep doing that again.
Yeah.
All right. Trend 8 of 10 I've got. Relationships matter even more. I'm not saying relationships never didn't matter, but from our experience, oh my gosh, because there's so much junk and noise, who you know and showing up at places like this really do matter. I can't tell you how many like deal flow spam garbage things that I get now. We talked about how much deal flow to sort through. It's ridiculous, and I can't. So the best deal flow comes from the people we know. Chris, we talk all the time. We get stuff from Lofty, Josephine Collective. I can name all sorts of others in this room. And I'm going to encourage you guys to lean into that because I think over time that really is where the good deals come from. And I have found, I'll call it a trend, when you keep helping others, it comes back to you in a good way. This is also a bit of the Chicago ethos. We've got a monthly-ish newsletter we send out with our deals, and it's so cool when people get that and they're like, oh my gosh, I love this deal. Can you make an intro? You make a few intros. Those are the same people that 3 months later are like, oh man, I got this cool deal. You guys want to check it out? And people ask, like, how do you get deal flow? How do you get going? Helping is my #1 recommendation, and we keep, again, seeing that the people who are active, those relationships will lead to good stuff as angels. Oh gosh, and develop good relationships with entrepreneurs and fellow investors. I'm talking about fellow investors, but entrepreneurs as well, and even if you don't invest in them, and communication etiquette matters. I want to say this as a little mea culpa because I screwed up something. I did a bad job of responding to one of my potential entrepreneurs. They had pitched, I thought I'd responded, and I actually heard someone say that they like said, oh, this is not good, what's going on? And I went back to my inbox and realized the person had sent me 4 emails. And I had 1 email out that was sitting in my drafts I had never sent. And appropriately, I got dinged out there in the community, and I should. And that's the kind of stuff to just recognize that it's real. Maintaining relationships, maintaining positive thing, it does matter because it's going to lead to that good deal flow. 9 to 10, start bringing this home. Location doesn't matter. I know Mike, I think, was talking about, it's so important you want to invest locally, and I think there's some truth there. But with Zoom calls, we get great info or intros and deals from across the country, and we're wide open to them. I feel like I've got a super close relationship with some of our entrepreneurs in Colorado and California because I jump on Zoom with them more than maybe someone who's local. So I'm not going to lean against that. We do still see a difference in valuations. You might think it should diminish perhaps, but I get why combinator companies coming out of Silicon Valley, they're still awfully expensive compared to the Midwest companies, but you can still get access to them. Again, but some people want to support local, it varies, but I'll at least say that Zoom is opening this up, and it can be a mechanism to maintain your relationships. Last trend I've got here, all right, 10 out of 10. A little yay rah for this summit here as well. We are seeing a lot more interest in the community. Brian and I started this run year number 7 of doing Chicago early, and we thought, we get some interest, and we did early, but now it is, I think there's an exponential curve of people getting comfortable with Angel. They love the idea of not only the returns, but they're helping people out. So thanks Lofty for this, because we're seeing more of these events. I'm just going to name drop here. If you want to get involved, if you're an angel who's not done this before, there are some just great groups you can dip your toe in. You got us, Lofty Josephine, Irish Angels Capital, all these folks, take advantage of them. They're there to help you out. They give you deal flow, they give you guidance, they give you education, so don't be afraid of those. Find your community. It now exists in a way that it didn't, so that's a great trend that we're seeing growing. Last thing I've got, I'm super proud of Chicago. I want to connect with you guys and talking about, keeping us all together. Hit me up on LinkedIn. You can look up Brian on LinkedIn as well, Brian Crump. But hopefully just gave you a few insights from all the pains and getting beat up out there on the front lines here for the past 7 years. Hopefully shared something that a nugget or two was helpful to y'all. And I'll be around later. Happy to chat. Woo! Go team!